In today's video, I will be running through 3 specific strategies that can be used to invest in bear and bull markets, depending on your experience level and appetite for risk. Welcome to Low Cap Collective, where we diagnose crypto investment strategies, especially cryptos with market caps below 300 million. In today's video, we're going to start with one important topic, which is just how damn good it's been. The last 2 years were massive. BTC gained over 500%, Ether gained over 1,000%, and crypto market cap gained over 1,000%. Now, when you think about these things, you think to yourself, yeah, it was pretty damn good. When you compare this to S&P 500, the return for the last year on the S&P 500 was around 10%. So, crypto's outperformed that by a significant margin. Moving forward, does that mean that crypto will continue to do the same thing? It's not certain, but it's probably unlikely that crypto will be able to repeat the same gains over the next year. However, anything is possible. But to start with, we have to start with the context of now, which is everything has been great. However, the market has been a bit shaky over the last few weeks. So with that in mind, are we actually in a bear market? Well, when you think about it, we could be in a bear market. Ether is down 55% off November highs, BTC nearly 50% off November highs, and the stock market is 10% off highs. Obviously, stock markets come out dramatically better, but the truth is that the macro doesn't look great. The Fed has been, printing money beyond belief for the last couple of years, which has obviously helped the pump. Significant interest, low interest rates. Obviously makes it easy to borrow cheap money, and you've seen plethora of VC funds spending capital like it's going out of business with huge valuations. This is obviously filtered over to the crypto market. DeFi and the protocols that we're most interested in, it's been difficult to find anything with actual significant value. It's not to say that a lot of these products won't have value in the future. It's just that a lot of them are copy pasta. A lot of the protocols are essentially rip-offs of the other, taken to another chain and slightly adapted because it's that damn easy to make money. And essentially liquidity moves from one protocol to the other based off the yields, but the yields are the protocol's own tokens. It's becoming very difficult to see where the inherent value is in DeFi. If we're in a bear market, which we well could be, if you look at the macro, then this could last a while. How do you protect yourself in the bear market? And how do you also protect yourself for the bull market? If you come back to one thing that we follow here, which is don't lose money. The main rule for us at Low Cap is make sure you protect your assets as much as possible. It's really difficult to do in crypto because the market is so volatile. Now, if you look at the market right now, you would say, okay, well, Ethereum's lost 50%, BTC's lost 50%, stocks are down 10%. How do you protect yourself from those sorts of downside risks? Well, the problem is that when you're working with cryptocurrencies, it's very difficult to not lose money. But the truth is how much money, right? Once you've made some gains, how much money can you lose? Do you hold onto your altcoins when they go up 200% and then you lose 90% of them again? Like, how do you know when to take profits? It's very difficult to understand and navigate the market. And if you're a trader, it's different because you're trading. But if you're an investor, a crypto investor, which is what most people aspire to be, then you have to invest, which means don't lose money. If this wasn't your money, would you be taking the same risks? That's how you have to think about it. You need a strategy. And the problem is that most people operating in the crypto space right now are not operating with a strategy. And one thing we do at Low Cap is making sure that we have a philosophy and a strategy that we can follow and that we can actually share with people so they understand that strategy is important. So what is strategy? Well, strategy isn't buying tokens in a specific niche, like I buy lending protocols on DeFi. That's tactics, that's what you do, that's your actions. So a strategy is actually a diagnosis. It's not, do I buy NFTs or do I buy DeFi? It's more about what's actually happening right now. What's actually happening in the large space? What's actually all of this about? So a diagnosis for us right now is that the macro market is extremely shaky. We haven't seen any bull market indicators whatsoever, and we're seeing bull market indicators in things that have been in bear markets for a long time. Commodities, for instance, blowing through the roof. We have a premise to believe that oil could reach $200. These aren't cryptocurrencies. These are markets outside of cryptocurrencies that we don't specifically trade that often. Diagnosis is that macro is looking pretty crazy right now and it's uncertain. So if that's our diagnosis and the market is uncertain, we can then move on to our next step, which is a guiding policy. Well, now that we know that the macro market is uncertain, we know that the crypto market is nascent and it's not easy to understand where the value is, and you have to do a lot of research and digging to see whether protocols are defensible and do they have a great team and all of the tokenomics around the products. Once we've kind of looked at it, we say, okay, what's a guiding policy? What do we want to move forward with? Then we put that in place and then we have some actions. Okay, now that we know what we want to do, what's the actions that we're going to take? So that's strategy in a nutshell. You have to have all 3 components to be able to create a cohesive strategy. If you understand that the macro is a little bit crazy, then I suppose you can look at the next piece, which is the barbell strategy. So If your guiding policy is a barbell and you say, okay, well, the macro is pretty crazy right now, we're not sure what's happening, the barbell strategy fits nicely into this. This is a strategy that's not that widely used, although people like to talk about it. It's been coined by Taleb and a few others about how effective it can be. But I think it's an underestimated strategy and one that people don't tend to stick with. The problem with a barbell strategy is that you have to sit on your hands, and it actually enables you to be able to sit on your hands and actually think about your assets much more. You have to think about your assets in a high conviction way. For instance, on the left-hand side of the barbell, you would have 85% in lower risk assets. And on the right-hand side of the portfolio, you would have 15% in speculative assets. In our case, in cryptocurrency, I'll show you a couple of examples. Barbell strategy 1. On the left-hand side, you could have 85% of your stables farming, and on 15% you could have in low cap specs and projects. Now, the truth is, lots of stuff in crypto is speculative. They're pre-revenue, pre-profit, and the market is very nascent. So it's very hard to argue that it's not speculative. Doesn't mean that it can't be a good investment, just means that it's not traditional investment. When it comes to investing, putting 50% of your portfolio into speculative assets is highly risky, especially when it comes down to the new VE economics that everyone's talking about, which again adds a more element of risk because you're locking up your tokens for a long period of time. Now, stables farming. Now, if you can farm with stables on your left-hand side of your portfolio, you can generate decent yields, somewhere between 10 and 20% at the moment, pretty easily. Obviously, you need to make sure there's smart contract risks with that, and that you don't want to be, using protocols that have, great team and the code has been audited and whatnot. But the truth is that stables farming is very appropriate for this stage of where we're at right now. If you can take that stable and farmers APY that you're earning, and you're earning that 10, 20%, you can then move that over to your low cap specs, especially if your stables farming on L2 like Arbitrum or somewhere else like Polygon on a sidechain. Stables farming is a great way for you to be able to protect your downside while simultaneously also beating inflation, which is another key point. If inflation is running at 7%, but in some cases, some people say at 15%, if you can return at 15% your stables, you're hedged against inflation. And that's without actually having any downside because you're stable farming. The rest of your portfolio, 15%, can be put into low cap specs. The way I think about it is the smaller your bag in terms of, not in terms of size, but in terms of positions, the better. If you can have 2 to 3% on each asset in your 15% low spec bag, that means that you can have maybe between 5 and 7 assets that you have picked that you can keep an eye on. And the key here is that you can keep an eye on them. If you can keep an eye on your assets, this means that those assets, you're able to analyze them specifically, get into their Discord, understand the fundamentals, and really understand what the team and the quality of the product is about. Is it defensible? What's their roadmap? Who are the investors? What's the vision? All these things you can start digging deeper when you have 5 to 7 projects. The problem in crypto is that a lot of people have 10 or 15 or 20 projects and they can't manage them. The other side of it is that if you go too heavy on 1 or 2 projects, that again is a risk because you're basically saying, and you're basically relying on that, knowing that technology is going to come, it's highly defensible, right? And the founders are operating in your best principles, which in crypto is very hard to do. We've seen that with WMemo and Abracadabra, that people are working in their interest. It wasn't defensible, and people are overexposed. That's not a position you want to be in. So this is one way of doing it. The second way of doing it is taking 70% of your portfolio and put that stables farming, and then the rest is actually in pool twos. Pool twos is essentially matching up a token you're invested in and then matching it with another pair like Ethereum, or if you was on Matic, for instance, and pairing it up with the blockchain pair. So this is another way to actually get exposure to something like Ethereum with 15% in your bag, and then your speculative assets at 15%. This is a little bit more risky because obviously you're in a pool two, right? Which means that you can actually get impermanent loss depending on your portfolio. We're not really concerned about impermanent loss at low cap. If you actually got high conviction in an asset and you understand that it's going to be probably going to be moving forward over time, you're willing to wait out and wait for that moment, and permanent loss is not really a factor. The other thing about pool 2 is you can actually generate APYs of over 100% in some cases. I think Magic APY is around 140% right now, and that can increase with time. It could actually go down with time, but it could also actually increase. So I think it really depends on your risk tolerance. Obviously here, if you lose your whole bag, if you lose the right-hand side of your barbell, you lose 30% of your portfolio, which isn't great. Some people have had 50 or 60 or 70% drawdowns. We've seen 90% drawdowns with altcoins happening over the last month or two. Now, that's not a good position to be in. This actually helps you to balance that out. 70% on the left side and 30% on the right-hand side. And there's some strategies that can help, that you can implement on L2, which we can go through on another video. So the third strategy, 85% on the left-hand side in Ether BTC, and then 15% in low cap specs, 2 to 3% each. About this strategy is that on the left-hand side, the way you have to think about it is that it's still a volatile asset. Ethereum and Bitcoin are volatile. Yes, there has been people that said gold isn't as volatile as BTC and vice versa. It's more volatile than BTC over the last couple of years, but over the length of time, it's not been. This is still a volatile portfolio. Now, if you're willing to take a 90% or 50% or a 60% drawdown, then this is a portfolio for you. And if you're a crypto investor that's, all in and you've got assets outside of crypto to help protect you, and we do recommend that you'd have emergency fund and this type of thing. If you don't have an emergency fund, it's pretty crazy to operate in this space. If you're overexposed in Ether and BTC and there's a huge market drawdown, then obviously it's hard to get yield in Ether and BTC, so it's hard to balance against that. Not to say that this isn't a viable way, especially if you believe in the Ether and BTC in the long term, this could be a great way. And then on the right hand side again, you'd have that 15% low cap specs. This is definitely the more riskier of the barbell strategies that you can take. Obviously, you could even on the left-hand side have other products. You could have Frax on the left-hand side, you could have Convex on the left-hand side. But are those truly defensible protocols? Truth is, nobody knows yet, and probably not. It's way too early to understand whether something's defensible. Nobody's talking about the modes. Most people are just talking about the tokenomics. Problem is in crypto investing is a moat is what's matter. Unfortunately, products can be copy-pasted, which makes it difficult to deliver a moat. So remember, when it comes to this, our thesis is don't lose money. Don't bet large amounts of percentage of your portfolio during uncertainty. If we know the macro is looking not great, if people are saying 3 to 4% per year, big hedge fund investors saying 3 to 4% per year is maybe the maximum they could achieve this year. We have to list these macro positionings. Yes, you can look at Russia on the daily. Yes, you can look at what's happening on the day-to-day. Day-to-day isn't the bigger picture. And if you get stuck looking in the macro, you get stuck looking in the news, you're actually looking at the wrong thing. The larger picture is this a bear market overall, or do you believe this is a bull market overall? If you look at it over a 1 year period, where do you believe this will be in 1 year's time? That's what you should be looking at. If you believe in 1 year's time, this is most certainly going to be a bull market, then maybe take more risk. But if you're not certain, you're unsure, don't walk into the fire. As the Tao would say, flow with the water, go with the flow, go with the markets. Don't have to jump in right now when it's uncertain, jump in when it's more bullish, jump in when there's actually a little bit more light at the end of the tunnel, that all the macro pieces add up. If you don't understand the macro, there's plenty of people, we can share them with you on this channel, that you can get some understanding about the macro picture. And you don't need to be a macro investor, but it's key to understand that you're not operating in a vacuum. You're operating in this macro piece, and Russia and all of this stuff matters short term, but normally it doesn't matter in the long term. So what's the long-term macro picture? Use that to identify what you should do with your portfolio. The second thing is keep liquid. Don't lock your tokens. If you lock your tokens for 4 years, you could potentially have problems. We don't lock our tokens. You're illiquid. Yes, you can make earnings. They normally, you're part of the protocol, part of the DAO, you can vote and whatnot. The liquidity is going to be important. And this is because once you start seeing indicators for bull markets, you want to be able to take advantage of those opportunities. You need to wait for the right opportunities. And that's a key piece. There could be seed rounds that come up that you could be involved in. There could be low cap projects that are released that we speak about on this channel or other channels speak about. You need to actually keep your ear to the ground. Wait for the right opportunities. It's not about jumping in. It's not about trying to be someone who can get a 10x return in the bear market. The key is just waiting, not doing anything too crazy, and taking your time. Remember, what we say on this channel isn't financial advice. We just give our opinion, and when people ask us, we give them the answers back. So this is our position on everything right now. It's uncertain, take your time and go with the flow. So for more of this, and to find out about our strategy, what we're doing, and the way that I approach portfolios and the way our team approaches portfolios, is to follow me on morph double underscore EOS, that's Morpheus. And then follow me on Twitter. In the description below, you can actually sign up for our newsletter where we'll be sending out more information about markets, what's actually happening in the macro picture, what's actually happening with low cap specifically that we've analyzed and gone through and seen if they're defensible. Because the key is it's not about tokenomics. It's about the product, the defensibility, and how this product and how a product can shift fundamental things in crypto. And there's plenty of these products that are out there. Most people are looking at the wrong things, and we're here to discover the ones that we believe that have the 1, 2 year, 5 year journey ahead of them, because they have something about them that other companies can't compete with and other protocols can't compete with. So thanks for listening, and I'll chat to you soon.